517,000 jobs added. So talk about making the Fed's job more complicated.
Inflation is still a drag on the economy, but monthly consumer prices rose 0.5% from December to January.
We saw that 0.5% increase in CPI month over month, which is a reacceleration.
An amazingly outsized print and catching the markets by surprise.
This suggests the Fed has more work to do.
More expensive gas, food, and clothing drove up inflation.
The likelihood that we could get a couple more increases from here is going up in the wake of this CPI report.
Inflation is still running hot, and so is the job market, which means the Federal Reserve could raise interest rates even higher than we expect. And while economic data keeps blindsiding investors, Michael Burry actually predicted this all years ago. Prepare for inflation, reopening and stimulus on the way. Pre-COVID, it took $3 of debt to increase GDP by $1, and it's worse now. An inflationary crisis is exactly what he was warning about as early as February of 2021, when inflation was still well below 2%. He immediately followed it up with this: the US government is inviting inflation with its modern monetary theory tinged policies. Trillions more stimulus and reopening will boost demand as employee and supply chain costs skyrocket. #paradigm shift. It's easy to look back and see how printing trillions of dollars and closing the economy would cause widespread inflation. Hindsight may be 2020, but not too many people saw this inflationary crisis coming before it hit. Yet Michael Burry did, and just a few weeks ago, he tweeted this: "Inflation peaked, but it's not the last peak of this cycle. We're likely to see CPI lower, possibly negative in the second half of 2023, and the US in a recession by any definition. The Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard." Well, it seems that Michael Burry's latest predictions on inflation and the recession could come true sooner than we think. Not because inflation is going down today, but because it's still higher than expected, and the job market is showing no signs of slowing, which gives the Fed all the ammo they need to keep raising rates until something finally breaks. The Consumer Price Index rose by 6.4% year over year, which was higher than the expected 6.2%. Not only that, but it rose 0.5% month over month in January, compared to just 0.1% the month before, and much higher than economists expected. But you know who shouldn't be surprised? Anyone who watches this channel, because rising rents and fuel prices were a big part of these inflation numbers. And here's just one of my videos from last November where I warned over 70,000 people of exactly that. The lower energy supply, thanks to the European oil embargo, is still ahead of us, which means that the final spike in gas and oil prices could still be ahead of us as well. And now we've come full circle. Rents account for 32% of the CPI. They don't go down very often and can lag the rest of the index by up to a year. Energy accounts for 7.5% of the CPI, and we've been subsidizing energy costs almost all year, using deployments from the Strategic Petroleum Reserve. These deployments are about to stop, right as winter drives up energy demand, and the EU sanctions on Russian oil and gas lower the world's effective energy supply. Let me be super clear here. I do not think that the market is correctly pricing in the real possibility of another peak in inflation. When all of these things make it into the data that the Fed looks at over the next few months, Jerome Powell might surprise the stock market by raising interest rates higher than expected, or keep interest rates higher longer than expected, or both. If that happens, we could see another big crash in the stock market. Don't say I didn't warn you. One way to protect your portfolio without compromising your investment goals is to invest in assets that aren't correlated to the stock market. I actually spent a lot of time digging into this, and Masterworks is a great way to do just that. That's because they're the only platform that lets you invest within multi-million-dollar paintings without breaking the bank. I like Masterworks because according to a recent report by Citibank, art had the lowest correlation to the stock market of any major asset class, and contemporary art prices have more than doubled the S&P 500's total returns over the last 26 years. Masterworks has an impressive track record of 11 exits, all of them profitable. With the last 3, investors realized a 10.4%, 35%, and 13.9% net return. With these kinds of results, it's no wonder that Masterworks has a massive waitlist to join. But right now, they're giving you VIP access to their latest offerings. So I'll leave a link to that offer for you in the description below. Alright, I've been pounding the table on how rents lag other inflation indicators and that fuel prices were being subsidized by the US Strategic Petroleum Reserve for most of last year. I'm not trying to toot my own horn here. I'm trying to show you why it's so important to dig into the data and not just read the headline numbers. Piped utility gas services are up 6.7% from December to January, and gas prices are up 2.4% as well. Rents also climbed by 0.7%. Likewise, a range of services, from car insurance to car repairs and from dry cleaning to movie tickets, all went up by around 10 to 20% over the last year. So we're really seeing inflation staying high across the board. But inflation isn't the only thing we need to care about. If we look at Michael Burry's tweets again, we also need to care about rising employee costs and demand, meaning that we need to pay attention to the job market. What does the job market have to do with inflation and interest rates? Well, let me explain. The Federal Reserve really has two main goals: keep prices stable and keep unemployment low. Price inflation and high employment are actually two sides of the same coin, because when everybody has a job, they have the income to buy goods and services, which means demand goes up while supplies stay the same, which means prices go up. On the flip side, when the Federal Reserve raises interest rates, money becomes more expensive for businesses and consumers to borrow. For us, this means higher interest rates on loans, credit cards, and so on. But for businesses, this means less money to pay people, which means job cuts, which means lower total demand for goods and services, which means lower prices. And of course, job cuts also mean higher unemployment. That's how price inflation, unemployment, and interest rates all connect. So here's our next problem. January's job market saw an unexpected surge in hiring, adding 517,000 jobs in January, which is almost double what was added in December, and a little less than triple than the 187,000 that the market expected. As a result, unemployment fell to 3.4%, which is the lowest it's been since 1969. That means the Fed can raise interest rates even higher to fight inflation before worrying about causing high unemployment, which is a bad sign for growth stocks. Earlier this month, BlackRock's global chief investment strategist, Wei Li, said that the stock market has priced in a takeoff. It's pricing in inflation coming down and central banks cutting rates in the middle of this year. And in the near term, beyond fear of missing out and chasing momentum, it's hard to see a fundamental reason for stocks to keep pushing higher. And it's not just BlackRock issuing these dire warnings. Just 1 week ago, the chief U.S. equity strategist at Morgan Stanley, Mike Wilson, said that the stock market is disconnected from reality, and it's going to hit a deeper bottom this spring. He expects a combination of deteriorating fundamentals, additional rate hikes, and an earnings recession to drive equities to an ultimate low this spring, adding that stock prices are about as disconnected from reality as they've been during this bear market. And of course, just a few weeks ago, Michael Burry made his stance on the stock market clear in this tweet with just one word in it: sell. Michael Burry made those same warnings about stocks crashing due to deteriorating fundamentals and an earnings recession, except Michael Burry made them months ago. U.S. personal savings fell to 2013 levels and the savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to the pre-COVID peak, despite all those trillions of dollars of cash dropped in their laps, looming a consumer recession and more earnings trouble. That was from May of last year, and in June he tweeted this: adjusted for inflation, 2022's first half, the S&P 500 is down 25 to 26%, and the Nasdaq is down 34 to 35%. That was multiple compression. Next up, earnings compression. So maybe halfway there. So Michael Burry expects a consumer recession, which will cause earnings to drop and the stock market to drop with them. Now we're hearing the chief investors of BlackRock and Morgan Stanley say the same thing. But wait, the S&P 500 is almost up by 15% since the start of last quarter. So doesn't that mean that Michael Burry is wrong? Well, here's what he said when the S&P 500 had a similar rally last August. The S&P 500 completed a 22% two-month rally, and the Nasdaq a 43% rally. The S&P 500 would fall another 42%, and the Nasdaq another 48% by the bottom post-WorldCom in late 2002. This is where we were in May 21st, 2001. Can't shake that silly pre-Enron, pre-9/11, pre-WorldCom feeling. Michael Burry tweeted that on August 14th of last year. Not only did the S&P 500 reverse and go down another 15% almost immediately after that tweet, but it still hasn't gotten back to that price today. And just a couple months ago, he reiterated the same thing. Early 2002, investors were asking why I wasn't buying WorldCom. Feels like that now. While the WorldCom scandal involved major accounting fraud, I think his tweet goes a little deeper than that, because nothing hides fraud better than a bubble. Enron, WorldCom, Nikola. In the early 2000s, we had the dot-com bubble. By early 2002, the Nasdaq had already dropped by 60%, but don't forget that the dot-com bubble actually took over 2.5 years to fully pop. By the start of October 2002, the Nasdaq dropped by another almost 50%, and that's exactly where Michael Burry thinks it could go from here. In another tweet from last year, Burry said that the market could reach 15% lower than the COVID low, which would be a little over 1,800 points. The S&P 500 is currently sitting at a little over 4,000 points, which means that Michael Burry expects it to fall about 55% from its current value. Now let me bring everything full circle. Here's why I'm so worried. Not only is the stock market not pricing anything in I just mentioned, higher inflation than expected, stronger job market than expected, or future earnings compression on the back of a consumer recession, but just like BlackRock's chief investment strategist said, the market is actually pricing in rate cuts in the middle of this year. Here's a quick clip from CNBC where both the former Deputy Assistant Treasury Secretary and the former chairman of the White House Council of Economic Advisors weigh in on what the latest jobs report could mean for the economy and the stock market.
What worries me still is the labor market. We've seen no signs at all that the labor market has slowed down. We had a very strong jobs report last month, and I still worry that we're not getting a good handle on that. To me, this report confirms that the Fed needs to be aggressive. We still have a ways to go before we have comfort that we have a handle on inflation. What I worry very much about is that we think that we're coming down, we slow down, and then towards the end of this year, inflation comes back up again, which makes it even harder down the road.
Mr. Furman, do you agree with that assessment?
I think the markets are just ridiculously complacent about the inflation situation right now. I don't see how we have inflation much below 3% this year. I don't see it coming down below that without a decent-sized recession, and nothing in this numbers gives me comfort. Even if you take out shelter, which is lagged, and the used cars, the so-called supercore, you're at an annual rate of 4.3%. For this month. That's faster than the pace in the last 2 months. And that is with some special things that were helping. Used cars, we got more relief there than we were expecting to. Medical services also fell. Those aren't things you can count on continuing to happen. So I think this inflation issue is real. I don't think it's going away anytime soon. And I think anyone who's overly calm about it is making me nervous.
So even if you take out rents and autos, inflation still came in higher than we'd expect, and the job market is showing no signs of weakness. And no matter who you ask, everybody agrees that inflation is going to take a lot more time to come down. Inflation peaked, but it's not the last peak of this cycle. We're likely to see the CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. Fed will cut, and government will stimulate. And we'll have another inflation spike. It's not hard. Michael Burry's tweet really highlights how the Fed is at a crossroads. If they stop tightening or even lower rates pretty soon, inflation is strong enough to still make a new high. And if they keep raising rates, they could plunge the economy into a recession, which means lower earnings and much lower prices for stocks. And of course, Jerome Powell himself constantly acknowledges this same thing. In fact, just a few days ago, here's what he said the Federal Reserve would do if jobs and inflation data kept coming in higher than expected.
If the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more. This is a world in which we've had the labor market report, and I think that we have a significant road ahead to get inflation down to 2%. And I think there's been an expectation that it'll go away quickly and painlessly, and I don't think that's at all guaranteed. That's not the base case. The base case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Either way, we could see another big crash in the stock market. Don't say I didn't warn you. But inflation isn't the only thing investors should be watching out for right now. There's another big disruption that you need to know about. So make sure to check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to share more research like this. Either way, thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.